Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the stock market, the S&P 500, and discuss the implications of a soft landing versus a hard landing. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So if you've followed financial markets for this year, obviously the primary focus has been around what is the Fed doing to combat inflation. And inflation has been going up for mostly the entirety of 2022 and obviously a lot of 2021 as well. But there is always speculation whenever we have a pullback with inflation that perhaps it has peaked year over year. If you go back, if you just simply Google has inflation peaked, you'll actually find a lot of articles back from early 2022 in March when we had this sort of slight pullback, and a lot of people were speculating back then that inflation had peaked year over year. You might wonder, why does it matter so much if inflation has peaked year over year? I think one of the main reasons is that if you sort of go back in time and look to see what the stock market has done, you'll notice that historically, when inflation goes through a period of really elevated levels, that actually occurs, the S&P bottoms tends to occur when the inflation year over year peaks. During the second peak that occurs, you don't really see the same type of phenomenon. The reason this occurs is what we've seen in the past. In the 40s and the 70s, we essentially saw inflationary decades. They were unable to get inflation under control, and it more or less stuck around for quite a long period of time. This is why you'll hear all sorts of stories about how cheap things used to be way back when, as you go through a decade of high inflation and everything's going to come out much more expensive. I mean, of course, we already have inflation, and of course, the target is about 2% on average every single year. But if you go through a period of high inflation for the better part of a decade, that's certainly going to send a lot of prices higher. If you go back to the 40s, you'll see a similar thing where inflation year over year peaked, and that's actually where the S&P bottomed. Now, what I want to draw your attention to, in both of these instances, okay, in the 30s, the S&P dropped about 50% when we had that period of high inflation. And then in the 70s, you saw the same thing occur, right? So if we zoom in here to the 70s, you'll notice that this bear market took us down to the tune of approximately 50%. Now, the reason why I want to talk about that or show that, bring that to your attention is because what does that mean in terms of the implications of a soft landing or a hard landing, okay? So you'll likely notice that the S&P has been putting in a series of lower highs and lower lows. And most recently, it actually was rejected off of its 200-day moving average. We talked about this in a prior video, in fact, that this was a key area to watch. And one of the things that I want to draw your attention to is that so far, these lower highs and lower lows are sort of, potentially, right, taking us down to the pre-pandemic high, okay? So the pre-pandemic high is what I would consider to be a soft landing. Now, I should be clear, there's no guarantee that we make it there. Okay, there always exists a possibility that inflation year over year has already peaked, the S&P has already bottomed, and that investors are being too bearish. However, if inflation has not yet peaked and we end up spending quite a long period of time with elevated inflation, Powell even spoke about that recently, that sometimes it's just the expectation of high inflation leads to more inflation because people are wage inflation, people are getting paid more. Goods just tend to go up because essentially everything's going up, and everyone thinks that everything's going to continue going up. So if inflation becomes entrenched for years and years and years, then certainly there's a much higher risk that we have further down to go. Now, remember, it was in the 40s and the 70s that the S&P it went down about 50%. And if you look at where we are right now, the S&P has only gone down about 24%. Now, if the S&P has already bottomed, I don't even think this would be considered a soft land. I mean, this would just be considered just a minor pullback, right? Or a very brief bear market that we came out of relatively quickly. However, there are certainly risks of it going down into a soft landing. So I would consider a soft landing to be about a 30% correction, where the S&P essentially goes down to the prior highs of the before the pandemic started, right? So I would say that if the S&P falls approximately 30% to the pre-pandemic highs, this would likely be considered by many to be a soft landing. I mean, and I don't know exactly the direction we would go to get there. Maybe we come down and then go back up and then come down like that, something like that. I don't know. I don't know the way we would actually get down there if we just go straight down or what. But if we do go down, if the S&P goes down to about the 3,400 level and then finally finds a bottom there, I would consider that to be a soft landing. I don't really consider that to be a hard landing. A hard landing is more, I would sort of equate that to some of the more punishing bear markets that we've seen even in recent history. Okay, so for instance, if you're not aware of what I'm talking about, go back and look at say like 2000 and 2008. During those periods, the S&P again saw corrections to the tune of approximately 50%. So again, if the S&P were to bottom down about 30% from the all-time high, I would say that the Fed would have achieved their goal of a soft landing. Now, the Fed, Powell, I think he's worded things very, very carefully throughout the entire year. And I think what they really want to do is they want to achieve a soft landing, but they also don't want inflation to become entrenched. If inflation becomes entrenched, like it did in the 40s and the 70s, then the stock market could go down a lot more. But furthermore, it's just going to lead to a lot of pain for a lot of people because everyone's going to be getting priced out of everything. It's like the real estate market is up significantly. Asset prices have come down some, but a lot of things remain relatively elevated. And I think this is their primary concern right now, not the portfolio of investors that are looking for returns on very risky assets. So I would say that if the Fed accomplishes their goal of a soft landing, then it would get no worse than approximately a 30% drawdown for the S&P 500 from the all-time high. Okay, going into the pre-pandemic high, we consolidate there, and then we finally break out of these lower highs and lower lows, and we do something else, and maybe we continue on our merry way. However, on the other hand, what if there's a scenario where inflation has not yet peaked year over year? Okay, or maybe it has peaked and maybe it just goes sideways at these levels for 6 months or something. How could that affect things? Well, if something like that were to happen and the Fed is unable to get inflation under control in short order, then you have to wonder, would we be due, in fact, for a hard landing? The reason why we need to talk about this is because a hard landing might be more similar to those 50% corrections we've seen in the S&P 500. Not only in the year 2000, we also saw it in 2008, we saw it in the 40s, we saw it in the 70s during periods of high inflation. These are risks that we have to consider. Now, a 50% correction from the all-time high, I know it seems ridiculous for the stock market because we haven't seen this in quite some time, but a 50% correction would essentially get you down to almost the lows in March of 2020. And that does sound relatively crazy, right, for us to go back to those levels. And one of the things to consider is that a hard landing, I would consider to basically be anywhere in this area, probably to the tune of, I don't want to say 31% would be considered a hard landing, but if the stock market ends up coming, let's say it comes down and then it comes back up, and instead of breaking out, if we then get rejected again and come down here, and then we don't find a bottom until say like the middle or late part of 2023, then I would consider that to be a hard landing. And that is what the Fed is trying to avoid. Okay, this is what they're very much trying to avoid. Now, this is why you need to keep an eye on inflation, on is it actually going to come back down or is it going to remain elevated? Oil is an important thing to look at. This is probably one of the biggest concerns, I think, with inflation. Obviously, there's a lot more that goes into it. Real estate prices, rent, food, a lot of other things go into inflation calculations, but oil is certainly something that people feel quite a bit when it costs a lot more money to fill up their car, for a full tank of gas. So oil is something that I think we should continue to focus on. I've been talking about it some on my channel recently, and one of the reasons is because there's sort of this idea that, well, what happens if oil is in the process right now, in fact, of breaking out? Because I was talking about this, the strategic petroleum reserves and how it's being depleted relatively quickly. And what I want to do is I want to zoom in here on oil. This is my concern is oil breaking out now? Maybe it's coming in for, a retest. If it starts to break out, that's likely not going to be a good thing for inflation year over year. It could renew inflation fears. And this is definitely what the Fed wants to avoid. So it's a very delicate game. The Fed is in a position that really is it's hard to win. Um, if they pivot prematurely, then risk markets might like it initially, but if it leads to inflation being entrenched for the better part of this decade, for the 2020s, then that's not going to be good for risk markets. It doesn't mean we can't put in new all-time highs, but if you go back and look at say the 40s and the 70s, what you'll notice in both of these times, okay, so let me scroll all the way back to the 40s and the 70s. This is a period where, yes, sometimes you put in new all-time highs, but it's a fairly lackluster environment for risk investors, right? I mean, you put in a high, you put in a low, and then a higher high, and then a lower low, and then a higher high, and then a lower low. This took from like 1966, and then we finally put in our final low here in 1974. This was 8 years. And really, it took a lot longer to then go on and go into another bull run. Okay, so this is something that you need to consider. This is the risk. A lot of people want the Fed to pivot, but I don't think it's in our best interest if the Fed pivots right now. I think it's in our best interest if the Fed does not pivot. Hopefully, we can get inflation under control, and we don't have to spend the better part of a decade in a high inflationary environment, and that we can then continue on business as usual. If, on the other hand, they're unable to achieve this and inflation continues to stick around, then what happens is we very much run the risk of getting into a very similar phase like the 70s, where perhaps you do, maybe you come down for a bit, and you have sort of, this bear market, and then you go up and you put a new all-time high, but inflation is still running rampant, and we just come back down. Like, this is sort of the type of environment that we've seen in the 40s and the 70s when inflation was high. Okay, so this is the risk, in my opinion, of the Fed pivoting too early. It would be in our best interest, I think, if they actually get inflation under control before we turn back to risk on. Okay, the other thing you can look at is we had a brief period of that over here in 2018, in fact, where we were sort of putting in higher highs and lower lows. Okay, so you'll see that. I can even just stretch this out here. Maybe I'll stretch it all the way to where we currently are. What you'll notice is we put in a high. Sorry, let me fix that. We put in a high and then a low, and then a higher high, and then a lower low. And then we sort of had this fake breakout, and then the black swan right of the pandemic, and then a lower low again. And we finally broke out. But this is a period that also looked like the 70s, just compressed a lot. Okay, so there is a risk that we go into some type of environment like that, especially in an inflationary environment like we're currently in. So interestingly enough, if you actually go to the pre-pandemic high, this sort of trend line from way back over here is actually coming in at around the same level at approximately 3,400 for the S&P 500. So I think that's what I'm going to be watching primarily going into the end of the year is, will the Fed achieve a soft landing where we sort of come in and we hold that 3,400 level as support? Again, there's no guarantees we even get there, right? I mean, if the markets are going to do whatever they want to do. But if we do come in 3,400, I think that's where a lot of investors, especially that want to take on risk, who are sort of sitting on the sidelines right now, I imagine many of those would probably start to take on a bit of risk there, and hope that the Fed is able to achieve a soft landing. If they're unable to achieve it because inflation remains just really high, then you still run the risk of a larger correction, a 50% pullback. And, I know a lot of people don't like that, and it's not a popular topic, right? But we have to be unbiased. We can see plenty of times in the past where the stock market has corrected 50%, right? In the 70s and the 40s. It happened in 2008. It happened in the year 2000, which really wasn't even that long ago. It's really not even that long ago when we saw these 50% corrections. So this is what we want to avoid. We need to keep an eye on inflation and see if it can come back down. And if not, then you need to prepare yourself. How are you going to navigate an environment with high inflation? Because during those periods of time, it's very difficult, because even if risk assets go up, maybe they're not going up when you account for inflation. Hope you guys like the content. Make sure you subscribe, give the video a thumbs up. We also have an Into the Equityverse Telegram channel, which you can find a link to in the description below. I'll see you guys next time. Bye.